Imagine you're sitting in a real estate office. The agent slides a paper across the table. On it is a number, $525,000. They smile and say, "Good news, you're approved." Approved. The word feels like success, validation, progress. You worked hard, you built your credit, you saved for the down payment. The bank ran the numbers and decided you qualify. So it must be affordable. Right. Now fast forward 5 years. The excitement of move-in day is gone. The furniture is no longer new. The neighborhood no longer feels like an achievement. But the payment remains. $3,400 per month for the mortgage. $650 for property taxes. $180 for insurance. $400 average utilities. Maintenance you didn't plan for, repairs you didn't expect. And suddenly your income hasn't grown the way you imagined it would. Vacations stopped, retirement contributions slowed, emergency savings stalled. You're not broke, but you're tight every month. This isn't a worst-case scenario. It's the median homeowner experience. And it happens because most people confuse approval with affordability. They are not the same thing. When a lender approves you for a mortgage, they aren't asking whether this house will limit your retirement savings. They aren't asking whether this will increase financial anxiety. They aren't asking whether this will delay your freedom. They're asking one question. Can you technically make the payment? Banks use something called a debt-to-income ratio. In the United States, many lenders will approve borrowers whose total monthly debt payments are up to 43% of their gross income. Some go even higher. That means if you make $8,000 per month before taxes, the bank may allow you to commit roughly $3,400 of it to debt. Notice something important. That's gross income, not what hits your bank account after taxes, health insurance, and retirement contributions. If your $8,000 gross income becomes $6,000 take home, and $3,400 goes to housing-related costs, you've already committed more than half of your usable money before groceries, transportation, or savings. But the approval letter doesn't show that reality. It just shows a maximum number. And maximum numbers are seductive. Financial planners often recommend spending no more than 28% of gross income on housing. This guideline became widely referenced after being embedded into underwriting standards used by institutions like the Federal Housing Administration. But even 28% of gross income can stretch households thin in high-cost areas. If you earn $100,000 annually, 28% equals $28,000 per year. That's about $2,333 per month for mortgage payment, principal and interest. But this often excludes property taxes, homeowners insurance, HOA fees, maintenance, and utilities. When you include everything, true housing cost often lands 35 to 45% higher than the quoted mortgage payment. This is where buyers underestimate. They budget for the mortgage. They forget the ecosystem. A house is not a payment. It's an ongoing financial organism. Being house poor doesn't mean you can't pay your mortgage. It means your house consumes so much income that everything else shrinks. Retirement contributions become optional. Emergency funds stop growing. Career risks become impossible. Lifestyle flexibility disappears. The house becomes an anchor instead of an asset. Data from the Federal Reserve consistently shows that housing is the single largest expense category for American households. And when that category grows too large, it crowds out long-term wealth building. Here's the uncomfortable math. Someone earning $90,000 annually, who buys conservatively and invests 15% of income, could accumulate over $1 million by retirement at historical market return averages. The same person stretching for a larger home and reducing retirement savings to 5% may retire with less than half that amount. Same income. Different housing decision. Six-figure difference decades later. Buying a house is not purely financial, it's psychological. Bigger homes signal stability, status, success, arrival. Smaller homes feel temporary. Conservative choices feel cautious. Underbuying feels like missing out. And in competitive markets, fear intensifies. If we don't buy now, prices will rise. If we don't stretch, we'll never upgrade. If we don't get the extra bedroom, we'll regret it. These thoughts feel rational. But most long-term financial stress doesn't come from missing out. It comes from overcommitting. Let's look at two buyers. Both earn $110,000 annually. Buyer A purchases a $400,000 home. Buyer B stretches to $575,000. The difference in monthly payment may be $900 to $1,200, depending on rates. That difference invested monthly at 7 to 8% over 30 years becomes hundreds of thousands of dollars. Not saved, not invested. Gone into square footage. The larger home may appreciate, but so would the smaller one. And appreciation is based on market forces, not how financially comfortable you feel living inside it. Here's the quiet truth. The house you can technically afford is often not the house you can afford without sacrificing your future. Approval is a ceiling. Affordability is a strategy. And most people mistake one for the other. Understanding how much house you can really afford requires more than plugging a few numbers into a mortgage calculator. There's a widely accepted guideline often referenced by lenders and financial planners, something called the 2836 rule. On the surface, it sounds simple. Your housing-related expenses shouldn't exceed 28% of your gross monthly income, and your total debt payments, including your mortgage, car loans, credit cards, and student loans, shouldn't exceed 36% of gross income. This rule is a rough threshold used in lending decisions and as a starting point for affordability discussions. But like most financial heuristics, the 2836 rule is a guideline, not a guarantee of long-term financial health. It might help a bank decide how much to lend you, but it doesn't ask the deeper questions that your future self will care about. What happens to your daily budget after housing? How does that mortgage affect retirement savings? What if unexpected costs arise? Lending standards have been known to allow ratios even higher than 36%, sometimes up to 43% or more, meaning a household could pour nearly half of its income into debt before the bank blinks. When you take the rule and apply it strictly as your sole benchmark, you often miss what every experienced financial advisor will tell you matter more than simple percentages: the ongoing and hidden costs of homeownership. Hidden costs are exactly what they sound like: expenses that aren't part of your mortgage payment, but are essential to owning and maintaining a home. Property taxes, homeowners insurance, utilities, landscaping, regular maintenance, and unexpected repairs are all part of the real monthly and annual financial flow of homeownership. According to recent homeowner cost analyses, these ongoing expenses can add up to tens of thousands of dollars annually. In one recent comprehensive study of American homeowners, the average annual cost to own and maintain a home beyond your mortgage payment reached more than $21,000 per year, with maintenance alone accounting for the largest chunk. Those figures aren't abstract estimates. They represent real dollars that flow out of a homeowner's pocket each year. In states with higher property values and taxes, like California, these hidden costs can exceed $30,000 annually. That matters because most buyers budget only for what they see, the principal and interest payment on the loan, and ignore what they don't see. When you buy a home, you're not just buying mortgage payments. You're underwriting decades of property taxes, insurance premiums, unexpected repairs, utilities, and maintenance that rise every year with inflation. These are obligations that most lenders don't build into your approved number, but that will shape your actual financial life. And the math here gets uncomfortable fast. A guideline that suggests only the mortgage payment should be 28% of your income becomes far less helpful once all ownership costs are factored in. Many financial planners suggest that if you aim to keep total housing-related costs, not just the mortgage, under 20% to 25% of your gross income, you give yourself a margin of safety. If you spend closer to the maximum lenders will allow, you could find yourself house poor, with little left over for savings, retirement, travel, emergencies, or even basic lifestyle flexibility. One big reason this happens is that common affordability formulas don't incorporate the reality that homeownership is dynamic. Property taxes tend to rise over time. Insurance premiums can spike due to natural disasters or changing risk profiles. Maintenance costs, often estimated at around 1% to 2% of a home's value per year, are unpredictable and unavoidable. Older homes, in particular, can demand well above that average as systems age and wear. Nobody handing you a pre-approval letter or showing you monthly payment estimates is going to tell you this. The narrative most buyers hear is, here's what you qualify for, go find a house at or below this price. And that is precisely the problem. Pre-approval is a cursory calculation of current income and basic debt ratios. It doesn't ask whether your budget will bend or break when real-life inflation, interest rate changes, insurance increases, school tuition, job uncertainties enters the picture. To really answer the question of affordability, you have to see housing costs in the full context of your life. That means factoring in retirement savings, emergency funds, healthcare planning, and the day-to-day expenses that aren't part of your mortgage or property tax bill. It means looking at your take-home pay after taxes and necessary deductions rather than the gross figures lenders use. A deeper reality emerges when you start separating what you can be approved for from what you should commit to. Approval often reflects the maximum risk lenders are willing to take given your income and credit profile. Affordability reflects your long-term financial resilience. This is where the math becomes personal and consequential. A household earning a typical middle-class income might technically qualify for a home at a certain price point, with total debt ratios within acceptable lender limits. But once insurance, taxes, utilities, and maintenance are added, housing costs can balloon far beyond what is truly sustainable, sometimes requiring 30% or more of take-home pay just to stay current on expenses. If your income isn't rising fast enough to keep pace with those increasing costs, each year narrows your financial flexibility, leaving less discretionary income, fewer savings, and a greater risk of financial stress. The market data reflects this squeeze. Recent national housing cost trends show that typical monthly housing expenses, including mortgage, insurance, and taxes, have climbed faster than inflation, placing additional pressure on household budgets. In recent years, median costs for new homeowners have risen into the thousands per month, even as incomes stagnate in many regions. This gap between lender guidelines and real financial experience is the reason why financial advisors often recommend going well below what a lender says you can borrow. Your goal isn't simply ownership, it's ownership that doesn't cripple your ability to live, save, plan, and grow financially. So when someone asks, how much house can I really afford? The question isn't about pre-qualification letters or down payment calculators. It's about your whole life, today, and decades into the future. It's about what level of commitment preserves your financial freedom rather than limits it. It's about recognizing that the true cost of homeownership is not just monthly payments, it's everything that comes after you bring the keys home. If you want to know how much house you can really afford, you have to stop asking the bank and start asking your future. Most online mortgage calculators are designed to answer one question. How large of a loan fits inside a lending formula? You enter income, debt, interest rate, down payment, and the tool produces a number. The number feels mathematical. Objective, precise. But what it rarely includes are the variables that determine long-term financial stability. It doesn't subtract aggressive retirement savings. It doesn't factor in career breaks. It doesn't model childcare, aging parents, job loss or health shocks. It doesn't measure opportunity cost. It gives you a ceiling, not a strategy. So what does a strategy look like? It starts with reverse engineering your life. Instead of asking, how much house can I afford? You ask, how much do I need to invest monthly to retire comfortably? How much do I need in emergency reserves? How much flexibility do I want if my income changes? Then housing fits inside what remains, not the other way around. A conservative framework many fiduciary planners use works like this. First, commit to saving at least 15% to 20% of gross income toward retirement on long-term investing. Second, maintain 3 to 6 months of essential expenses in liquid emergency reserves, ideally more if income is unstable. Third, ensure total housing costs, mortgage, taxes, insurance, utilities, maintenance, stay closer to 20% to 25% of gross income, not the 28% maximum lenders use. When housing remains in that lower band, something powerful happens. Your life has margin. Margin is what protects you from stress. Margin is what allows career risks. Margin is what turns a home into a tool instead of a trap. Now let's make this tangible. Imagine two households earning $120,000 annually. Household A buys at the top of their approval range. Their full housing costs reach $3,500 per month. They reduce retirement savings to 7% to make it work. Household B buys 20% below their approval limit. Their housing costs total $2,700 per month. They maintain a 15% retirement contribution. The $800 monthly difference invested at 7% over 30 years becomes roughly $900,000. Not because they earned more, not because they got lucky, because they left margin. That difference is not visible on move-in day. It becomes visible decades later. The larger house does not usually generate a $900,000 increase in lifestyle satisfaction. But the invested difference can generate financial independence years earlier. This is the opportunity cost most buyers never calculate. Square footage competes directly with freedom. The more income you lock into housing, the less optionality your future holds. And optionality is wealth. There's another layer to this. Housing markets move in cycles, interest rates change, property taxes rise, insurance premiums adjust, especially in climate-exposed regions. When you stretch to the maximum today, you assume tomorrow remains stable. But financial resilience requires assuming it won't. A homeowner operating at 25% of gross income can absorb rising insurance or tax adjustments without panic. A homeowner operating at 40% cannot. The difference is not income, it's cushion. And cushion determines whether your house feels like security or pressure. There's also the psychological component. When housing costs are high relative to income, you unconsciously make decisions differently. You avoid career changes. You tolerate jobs you dislike. You postpone entrepreneurship. You hesitate to relocate for opportunity. Your house begins to dictate your behavior. When housing costs are moderate, you choose differently. You negotiate harder. You pivot careers. You invest more aggressively. You take calculated risks. In that sense, affordability is not just math. It's behavioral architecture. It shapes who you become. Now, consider this from another angle. If you buy less house than you're approved for, you are not settling. You are buying leverage. Leverage in your savings rate. Leverage in your stress levels. Leverage in your timeline to financial independence. The market does not reward buyers for maxing out their approval. It rewards time and ownership consistency. A modest home held for 20 years in a strong market often outperforms a stretched home purchased at peak affordability stress. And appreciation, while powerful, is not guaranteed annually. Markets stall, they correct, they stagnate. If your financial stability depends on appreciation, you're speculating. If your financial stability depends on affordability margin, you're planning. The difference is subtle in the beginning. It's dramatic in the end. Here's the quiet formula most financially stable homeowners follow. They buy the house that allows them to keep investing. They buy the house that allows them to keep saving. They buy the house that allows them to sleep. Not the one that maximizes pre-approval. Not the one that impresses peers. Not the one that stretches ratios to their limit. The one that preserves trajectory. Because trajectory is everything. A household saving 18% consistently will almost always outperform a household saving 6%, regardless of house size. Time magnifies small behavioral differences, just like in retirement savings, just like in debt management, just like in investing. Housing is no different. The uncomfortable truth is this: most financial strain tied to homeownership is self-inflicted. Not because people are reckless, but because they misunderstand what affordability actually means. They think affordability equals qualification. It does not. Affordability equals sustainability under stress. If your payment feels manageable only when everything goes right, it's too high. If it remains manageable when income dips, expenses spike, or markets wobble, it's sustainable. And sustainability compounds into freedom. So how much house can you really afford? You can afford the house that allows you to continue investing aggressively, maintain emergency reserves, absorb rising costs without panic, pursue opportunity without fear. Anything beyond that may still be approved. But approval is not protection. The bank evaluates risk for them. You must evaluate risk for you. 30 years from now, your future self will not remember the granite countertops. They will remember whether they felt trapped or free. They will remember whether retirement came easily or required compromise. They will remember whether the house supported their life or consumed it. You do not accidentally build financial stability. You deliberately design it. And the price of that design is often choosing less house than you technically qualify for. The maximum mortgage is not a goal, it's a warning. Affordability is not about what you can survive, it's about what you can sustain without sacrificing your future. And that difference is where financial security is built.